Welcome to the ARR Reckoning, a webinar intended to decode the software stress across credit markets. I'm Winnie Cisar, the Global Head of Strategy at CreditSights, and joining me today are Andrew Hedlund, a Managing Editor at Levfin Insights focused on private credit, John Kim, a Director and Senior Covenant Analysis Analyst at Covenant Review, and Lyle Margolis, the Head of Private Credit at Fitch Ratings. Over the next hour or so, we will do a deep dive into the recent market action in the software sector across the high yield, broadly syndicated loan, and private credit markets in a collaboration between Fitch Solutions and Fitch Ratings. With Blue Owl selling private credit loans, many of which are in software to raise capital, there are a lot of moving pieces to address. Now, as always, we love questions from the audience, so please drop any questions you may have in the Q&A box. We'll attempt to answer as many as we can, and anything we don't get to, we will follow up with you later after the webinar. We also, of course, have the emojis going, so keep them coming. If you like what we say, don't like what we say, we'd love to know. Now, if you have listened to my webinars before, you know I love an audience poll, and this one is no different. So let's kick it off with one to warm up. The first question we have for you today is the software sell-off. What is your take? Is it A, overdone with value emerging? B, about right, risk is appropriately priced? C, more to come, repricing not finished? Or D, it's the bots, which is basically an I don't know kind of answer. All right, let's give some time for people to submit their responses, and then we will have to see what the audience says. Seems like the market today believes that maybe things are a little bit overdone with value emerging as equities are in nicely positive territory this morning, including tech ahead of NVIDIA and Salesforce earnings today. All right, we have almost half of the audience having submitted responses, so here we go. Okay, so I would say that this is a pretty wide distribution. We have some people thinking overdone, value emerging at about 36% of the audience. Just a little bit more than that, 40% of the audience think that there is more to come, that the repricing is not finished. And 18.7% of the audience think that it is about right and risk is appropriately priced. So, with that in mind, let's actually do a quick recap of how things have repriced. So far in 2026, technology is clearly front and center and not in the best way. Across credit markets, technology is underperforming due to concerns around hyperscaler issuance, return on investment, and most importantly for leveraged finance, the threat that AI may pose to software companies. While the underperformance is universal, the magnitude of underperformance is much more significant in the broadly syndicated loan market, where software services loan prices are down almost $5 year to date. This compares to a modest $1 move lower for the BSL index in general. Now, in high yield, where technology represents only 5% of the overall market, that compares with 15% for BSL. Software services spreads are just over 150 basis points wider year to date versus about 14 basis points for the market in aggregate. I also wanted to flag the IG tech space, which has lost about 30 basis points of excess return this year, even after Oracle's jumbo deal easily cleared the market. And the IG financial services sector, which is down by a similar amount, contains a good number of BDC issuers. So even in the IG world, some of these concerns are manifesting in returns. Now, the softer tech trend has been firmly in place since about mid-January, though we've definitely seen a few bounces higher, including one today, though none of those have really lasted more than a few days. Year-to-date, high-yield software is down almost 3% versus an almost 1% gain for high yield in aggregate and a 2% loss for technology overall. Now, one thing that I do want to highlight that I think is important is that the repricing in software and technology across the loan and high yield markets have been pretty isolated so far, rather than really pulling down prices and spreads wider across each market. This indicates to me that so far people are currently pricing in the software stress as more idiosyncratic rather than a true systemic stress. So, Andrew, I want to go to you first. How is private credit faring amid all of these headlines? Not necessarily just with software, but also with Blue Owl.
Thanks so much, Winnie. As she mentioned, I'm Andrew Hedlund. I lead the private credit coverage here at Levfin Insights. Turning to your question, Winnie, if we just start with software, The questions from people that I've talked to are several. Just to start at the highest level, there's questions and concerns about the enterprise value of software companies. That's specifically because a lot of lenders will tout low loan to value ratios. But of course, some of these companies were bought at rather high multiples. And so if they're not able to justify the purchase price, if it was, overbought, then will the value fall enough that the debt becomes impaired? So obviously you're largely paid off enterprise value. And the other question that comes to the fore when you talk to people about this is, are they painting software with too broad of a brush? I always say yes and no. Yes, in that software companies all do different things and there are nuances. No, as in AI will affect all of them and its ramifications are not clear. One of the things to think about when you're looking at individual software companies is the end market they are serving. So, for example, human capital management or HR software, they're having a tough time in a slower hiring market. So, when you put that alongside the challenges with AI, that makes for a 1-2 combo there. Another thing that folks have flagged to me are business services. Will the AI that's emerging take down a lot of those jobs? I think the best question is um, how are things developing in the current AI world, and what are possibilities in the business services area they could take down? It's really interesting because if you think about something like a consultancy, you're thinking, okay, well, do I need a AI bot that can help me figure out all this? And the question might be, well, if your company actually adds value beyond just the advice you produce, that's a reason that somebody could retain you. So that's what's going on the software side. Now turning to everybody's, the most intriguing headline are the Blue Owl BDCs. So the thing to highlight is that Blue Owl is liquidating Blue Owl Capital Corp, which we'll call OBDC too. It's not the outcome they had wanted. OBDC tried to merge with OBDC2, but that fell through because of where shares were trading. So on the one hand, the liquidating of OBDC2 isn't great because the firm will be overseeing fewer assets, right? This is to say, this is not judging how investors are being treated. This is just, on the income statement, that'll mean lower fee income and the book won't be growing as much. But on the other hand, you have the case to make that this is similar to a drawdown fund because there was a specified period of time and the management at Blue Owl had said we will have a liquidity event. So you can make the case that it's similar to a drawdown fund. But then there's the asset sale. And oh, I'm sorry, one more thing before I go to the asset sale. Blue Owl had successfully merged OBDC, the publicly traded entity, with OBDC3 in January 2025. So Blue Owl had done this type of merger before. On the asset sale, it's important to note that it wasn't a fire sale. The loans were not sold at a steep discount. It was roughly par 99.7 to be specific. And as well, it was a strip sale, meaning they weren't offloading positions full stop. That would give the type of idea that you're having the BDC dumping quote unquote bad paper, but that's not necessarily what happened. And then there's the nuance in the idea of gating. They are not gating in the sense that they are stopping distributions. They are still returning capital to investors. They're just no longer doing redemptions in the way that they used to. It's worth noting that Craig Packer, the BDC CEO, said on the call that they are doing this to treat investors fairly.
Great, Andrew. Thank you so much. That was a really kind of comprehensive overview. We had gotten a question on providing an overview of the Blue Owl situation from the audience, and you absolutely did that for sure. So I just want to highlight quickly that there has been a good amount of dispersion in performance in the LevFin markets on the software services side of things. Not surprisingly, the repricing of the software sector is very much reflected in ratings, with single B or lower rated issuers making up the bulk of companies in high yield, with a spread move wider than 100 basis points. This is year to date, and a dollar price move of more than $5 lower in the BSL market. Now, that doesn't mean that higher rated issuers have been totally immune. We've seen a 3.1 billion of double B rated bonds widening 100 to 200 basis points in that sector. And some of the BSL price drops are in the $10 to $34 area. But a lot of those issuers, I do want to highlight, had already been trading in kind of stressed or distressed territory. And I think that that goes back to some of Andrew's questions around the enterprise value of software companies really coming into question. We know objectively that there were a lot of deals at pretty stretched valuation points. I've seen some stats that a lot of the software services loans are at 30% loan to value rather than the kind of traditional 40% loan to value. And I think that that had already started to be flagged by the market, even leading into what we're seeing. Now, next, I want to go to the primary market because, of course, liquidity is important for issuers across the LevFin universe. And Andrew, can you just give us a quick overview of some of the recent LevFin primary market activity? I think that we've already seen a little bit of a slowdown in high yield bond issuance across the board. That's especially true when we compare it to the really robust supply of USIG. Are you seeing the same in BSL? And is there any chatter on the private credit side of things?
Sure. So the biggest software underwrite currently in market is Qualtrics. It is on the forward calendar and it is a $5.3 billion issuance. Notably, there is a carve out though for probably 2 billion to go to private credit or high yield. That's an interesting nugget to keep your eye on. One of the other deals in the BSL market is Alliance Ground. It's a Lone Star LBO, an $890 million TLB, term loan B. And then one of the other interesting ones is that there's a loan for Conga. It was a $625 million incremental that was funded by the underwriters for an acquisition. So that situation is something to keep your eye on, particularly as software isn't doing very well. In terms of private credit, the deals that have closed recently or are about to close are ones that have been signed up. The Clearwater Analytics LBO was announced in December. OneStream was announced in January. And the reason the reason the timing of this is important is because it would be nothing short of disastrous if a lender were to pull back on a commitment. The question would continue to hang over their head if they're a reliable counterparty. So if we just put that another way, to say bluntly, other firms wouldn't be sure if that lender was good for the money they said they were.
Yeah, I mean, we absolutely don't want kind of hung private lender deals. That would be a really negative indication. I do want to just highlight some of the primary market activity that we've seen in the sector historically. I think that it's important to differentiate between, of course, high yield bonds and BSL. Software has never been a major driver of supply in the high yield bond market. It averaged less than 3% of overall new issue supply in high yield bonds from 2016 to 2024. 2022 was a bit of an outlier at 8.2%, but that was also a very low new issue year overall. It's definitely different in the broadly syndicated loan market. Software services averaged about an 8.4% share for the same period of 2016 to 2024. And there was a high of 13.2% in 2022. The prior high was 11.8% in 2020. Year to date, we've seen about 1.9 billion of software price in the BSL market. That's about 2.7% of new issue and zero software deals in the high yield markets. So let's go to our second audience polling question to turn a little bit more to fundamentals. What indicator do you rely on most to assess software credit deterioration early? So are we looking at net retention and churn metrics, ARR growth and the bookings pipeline, free cash flow conversion and a liquidity runway, leverage and interest coverage, or sponsor support equity cushion and willingness to inject capital? For me, that would not necessarily be an early indicator, but curious to hear what the audience has to say. So, Andrew, I'm going to put you a little bit on the spot right now. We have an audience question about the Blue Owl fund liquidation situation. Is that specific to Blue Owl, or is that something we should be looking at for other BDCs?
It really depends. The tough thing with the Blue Owl situation is you have to try to separate the signal from the noise. And the signal here that the market gave Blue Owl is not exactly positive, but the noise is how much of that signal is, kind of silly or isn't justified. And I think the important thing is to look at specifically the performance that each of these individual assets in the Blue Owl funds have, because a lot of the other large BDCs hold the same assets. So is this just a panic around Blue Owl? It could be, but is it indicative of a wider issue in private credit portfolios?
Mhm.
Also, it could be. I know that's a little unsatisfying of an answer, but it's just a little too early to tell on which specific assets, because
Mhm.
we're only in the opening innings of this AI issue in private credit.
Yeah, I think that that is a great point overall. All right, let's see what the audience has to say about early indicators. All right, so most people are looking at the top net retention churn metrics. That's about 42% of our audience. And then annual recurring revenue growth and bookings pipeline, and then free cash flow conversion and leverage and interest coverage. Now, we have some really great data from our colleagues at Bixby, which is one of our sister companies. And then we also have CreditSights high yield credit metric data. And I compiled some information on what we're seeing in the leverage software services issuers across the high yield broadly syndicated loan, and then a proxy for private credit markets. For purposes of these slides, I used a cap of 100 million of annual EBITDA as kind of our proxy for private credit here. Now, as you can see, software credit metrics are strongest in the high yield market. That is something that we observe across all sectors within high yield versus BSL, with high yield having a little bit better fundamentals overall, lower net leverage, stronger interest coverage. But broadly syndicated loan software margins are actually kind of pretty good despite higher leverage points and interest coverage of just under 2 times. Now, our private credit proxy is showing a bit more signs of stress with leverage well above 10 times. That is not adjusted. So, adjusted, that is a little bit lower, and interest coverage below 1 time, while EBITDA margins in that private credit proxy are the lowest of our three universes after coming down pretty significantly from 2024 type levels. I also just want to highlight that when we look at the markets in aggregate, software fundamental trends are in general a little bit more stretched than the broader market. When we think about just the broadly syndicated loan market, interest coverage there for the entire market is about 2.24 times. Net leverage is about 5.6 times. So that's more than a turn lower net leverage for aggregate BSL and about a half a turn higher in interest coverage. This dynamic is also true when we consider the private credit proxy universe, where net leverage is about 9.4 times versus almost 11 times for the software services. So, Andrew, when you are talking to clients, where are people most focused from a fundamental perspective? I know a lot of people have been highlighting the higher proportion of pick deals. What are you seeing there?
So I just want to start by touching on the BSL space. It's really interesting. The bid change overall has been quite remarkable for the software companies versus the overall bid. The overall bid yesterday for loans was 95.07, and for software was 88.13. And the year-to-date returns on the software sector were down by more than 3.5% on a month to date, and only 61 basis points on a month to date. Month to date. I'm sorry, the software numbers should have been month to date as well. The trend in the market has been interesting for the BSL side. AI is becoming a concern for for more businesses. Last year, there was some specific businesses that had questions around whether around what the business diversification was. Businesses that had a narrower focus and could have been easily replicated by AI were very much in the crosshairs. Now that's really grown to enterprise software companies as well. The thing that investors are focused on, oddly enough, isn't earnings or cash flow. They're worried more about the future, which is kind of the very existence of these businesses, or at least a large part of it. That's led to lower trading volumes. And the other thing that people should be watching is the level of leverage. When he just touched on that, but the idea is that if your leverage is too high, you'll spend too much money servicing debt, and you won't have the cash to do capex on AI. And then when you mentioned pick, the question around pick should be, is it good or is it bad? And I say good and bad, not to put value judgments on them, but just specifically at the outset of pick. I'm sorry, good pick being at the outset of the loan. That feature was worked in. Bad pick meaning it was integrated later. And obviously, each circumstance is unique. So you can make a value judgment either way, but my 2 cents is kind of, if you are not able to afford cash interest, then you being in a position to make capex investments to capitalize on opportunities presented by AI is much more circumspect than not, I'd say.
Yeah, absolutely. I think it's very difficult to solve debt problems with more debt, which is oftentimes what that what that bad pick is kind of attempting to do. All right, so Lyle, I'd like to bring you into the conversation because you are deep in the weeds of fundamentals for private credit and have a good handle on what's going on in the technology software space. What stands out to you in terms of software fundamentals in the portfolios that you monitor?
Yeah. Hey, Winnie. So, yeah, you mentioned portfolios that we monitor. I just want to be clear for all the avid readers out there of our default research, who will know. Shameless plug, by the way. Who will know that we have two portfolios that we rate. One is credit opinions that we do for the ratings that we do on middle market CLOs, but the other is private ratings that we do, really for the benefit of insurance companies for regulatory capital purposes. And the slides here kind of focus on the ratings business because we have really the deepest insights there. We see these loans from inception to the end, whatever the end might be, pay down or something else. Um, so I hate to be the bearer of good news, but what stands out to me as you look at this chart is if you look at the credit metrics of the companies that we rate, um, the trends have actually been relatively strong, right? If we start on the coverage side on the right, you can see coverage came down, of course, as rates went up. But you could see that coverage is expected to rebound in 2025, continue in 2026. Obviously, part of that is the decline in base rates that we've experienced and that we also expect going forward. But part of that is also spread compression on new deals that are entering the portfolio. We don't really see a lot of kind of repricings the way we do on the BSL side. So it's really kind of new loans coming into the portfolio. But the good news is not just in rates. Like, we're seeing, leverage coming down also. Not clear how much of that is conservative underwriting for new issues coming in versus business models maturing and EBITDA growth. But if you look at the two charts below, revenue growth, EBITDA margin, it kind of gives support to the latter, business models maturing. You can see revenue growth is coming down, but still pretty healthy in the, kind of borderline, still double digits. We had some pretty high revenue growth, um, like in the kind of early years of the pandemic, as everybody was kind of moving to online. But you also see EBITDA margins improving quite a bit over the last couple of years, which really does suggest the latter, that these business models are kind of maturing, and you can see margins in this sector as high as 40%.
Yeah. So, given that you have seen some improvement in your privately monitored portfolio, how do you think about the ratings side of things? Can you discuss some of the ratings changes that you've seen? And then, as you're thinking about ratings, how do we think about the near term outlook? Is it base rates staying high going to be the big impact for software, or is it AI actually denting recurring revenue models?
Yeah, so the ratings profile, as you could kind of see on this chart, for the software sector within the PMR portfolio, it's actually been improving over the last couple of years. You could see that the percent of the portfolio in the triple C plus and below categories have declined from almost 30% in 2023 to around 15% in 2025. And a lot of that has been absorbed by the highest rating tiers, right? In B to B plus. We don't generally in the privately monitored rating portfolio, we don't see many ratings in the double B category or above. Um, to be clear, only a small portion of that is due to rating actions. We've seen over the past 2 years upgrades in that portfolio really only slightly exceed downgrades. Though I will say that last year we did have 5 upgrades in the portfolio versus just one downgrade. So that means the bulk of the improvement has been due to, for lack of a better term, portfolio construction. We had some lower rated names get paid off, which in its own right is good news. Seeing triple C rated issuances, get paid down, is a good sign for the market looking backwards. But we've also seen some higher quality new issuers enter the portfolio. And if you turn to the next slide, you'll see that the outlook distribution is also pretty benign going forward. Most issuers are carrying a stable outlook. And you can see here that the positives are outnumbering the negatives. You asked about what I think would be more impactful kind of near term. Is it base rates? Is it AI? I would say in the near term, it's base rates. I mean, base rates are a very blunt instrument. They hit everybody. And for a sector like this, where you've got a high level of debt relative to earnings, it's extra impactful. Our view is that we think the impact of AI is going to be more surgical on the sector. Some companies will be fine and might even be able to use AI to enhance their competitive advantage. Others may be more vulnerable. And we think that the differentiating factor is really going to be, how deeply embedded the company's products are in their customers' workflow. Customers that make a standalone application that provides a single function is at much greater risk of being replaced by AI, by an AI agent, than an application that supports multiple functions, is highly integrated in the company's workflow, and also interfaces with other systems.
Great. That is super helpful, Lyle. And I think that as we are considering catalysts for software or BDCs, private credit to broadly impact the market, we of course think about financing needs and the prospect that we see some sort of credit crunch in a particular sector that then kind of spreads into other sectors and issuers. Now, I want to say on the public market side of things, there's good news. There was a pretty significant refi frenzy in 2024 and 2025, and that helped clear out some near term maturities for the tech sector, for software services. That's especially true for high yield, where there's less than $10 billion of software that matures through 2028. In the BSL market, we have kind of a staggered maturity profile. We have a good chunk in 2028, some in 2029, and then a bigger chunk in 2031, representing, I would say, kind of the near to medium and term hurdles. Andrew, we have a question from the audience, which I think will be interesting. Could you share some information on leverage levels and pricing impact for software buyouts in the current market environment that's factoring in AI headwinds? I was reading a report earlier that was basically saying, lenders probably need an extra 100 basis points of compensation here, given all of the uncertainty. Would you kind of agree with that? What's your sense of it?
So the bar is definitely higher for software deals to get done today. The people that I've talked to, mainly lenders, are basically saying this is pencils down on software. It's an incredibly high bar to clear. But that's it's also important to note that some people are talking about it presenting an opportunity. We can lean in, get more, spread and alpha, etc. Do I buy that? I don't know. I don't have, their company financials in front of me. Theoretically, that's an option, but I'm very circumspect on that. In terms of what lenders are asking for, it's definitely higher spread, and there would be much more, much lower leverage for software deals. The existing software deals, particularly the ones that were refinanced in 2024, when there was a big refinancing rush, not only in the syndicated market, but also in the private market, can be quite high. So that's largely what you're seeing in the new issue market. I don't know if that was answering the question.
No, that's super helpful. There's a quick follow-up. Have you seen any major pullback in dividend recaps post kind of this market volatility? I know there was a little bit of an increase in the share of dividend recaps in new issue in the loan market, but I don't know if that has continued to be the case.
I think it's similar to what I was saying. It's a higher bar for
Mhm.
software deals. It's a little too early to measure the specific effect on recent deals because private credit deals take some time, and so you can ask this question and get a little bit more accurate of an answer.
Mm.
By middle to end of March. I can say for sure that the bar would be even higher on a dividend recap than it would for a software buyout. Because if you think about it, you're, taking on more debt to give the equity holder a distribution, right? Is that a smart idea when you have this type of market uncertainty?
Always a key question there in terms of whether that's a smart idea. All right, so I'd also like to note distress ratios, they are definitely elevated for the tech sector, for software services. But, compared to kind of the long-term historic trend of tech volatility, it actually looks relatively subdued when you go further back. Right now in the broadly syndicated loan tech space, about 12% of par outstanding is trading at a distress level. That's versus a post 2019 average of about 6.8%. So definitely elevated there. And then when we look on the high yield side of things, we're at about a 10.2% par weighted high yield software services distress ratio versus 6.9% since 2019, but meaningfully higher on a long-term basis. So, Lyle, I want to go back to you because we've looked at the maturity schedule for the high yield and BSL space. It doesn't look super frightening in the near term. How are you thinking about it for the private credit side of things?
Yeah. So again, I can only speak to the PMR privately monitored rating portfolio, given that the market, we don't have access to the universe. But speaking to the PMR, I can say that the maturity schedule in the PMR portfolio does look somewhat benign. At least when you compare it with the other sectors, you can see in the chart on the left. Sorry, the bar on the left, under 25% of the software sector debt in the portfolio matures in 2026 through 2028. And that compares to over 45% for the other sectors. That, the wall doesn't really kick in or doesn't really get kind of concerning until like that 2031, which is sufficiently far off, I would say, at this point. That said, I think the dynamics of addressing even that minimal amount of short-term maturities that exists is going to be interesting, given kind of what Andrew was speaking to earlier, what's happening with multiples, right? I think sponsors are going to be challenged to find acceptable bids to exit their positions, pay down the loans. So it will be very interesting to see what happens over the next couple of years. What we could see is some proverbial can kicking of maturity extensions. But what we found is that there's only so long that a direct lender is going to engage in that kind of behavior before turning the screws a little bit on the sponsor and kind of forcing their hand into some sort of repayment.
Yeah, that's super helpful. We had actually gotten a question from the audience on kind of software M&A. I know that a lot of people went into this year thinking more broad-based, the M&A was going to be a significant boon to all markets, including LevFin, including BSL and private credits. And it does seem like this is just an additional thing that the market is going to kind of have to clear in general. So, well, I just want to kind of crystallize. So in private credit, like there still is the opportunity for some amend and extend, but it's not in perpetuity for these issuers. Like there is kind of a time limit that they are running up against.
Usually, yeah, and I think it depends on the private credit fund, what their position is. But we generally do find that lenders will work with sponsors to some degree in extending maturities to the extent that they can based on the funds that they're in. But at some point, they will start demanding the company explore sales or put pressure on them to make sure that they're engaging in that type of activity.
Absolutely. All right. So let's move into the world of covenants because I think that covenant quality has come up quite frequently when we're talking about the software sector, given the high degree of sponsor involvement. And John, your team at Covenant Review have done a really good job highlighting some of the nuances in software covenants across the BSL and then also private credit markets. How do you see the differentiation from other sectors? And can you walk us through some of the reasons for that differentiation?
Yeah, thanks, Winnie. Everyone, I'm John from Covenant Review. I guess we can start with kind of an overview here with the documentation scores, which is Covenant Review's way of kind of grading deals in from least protective to most protective. Um, Least protective being a 5 and the most protective being a 1. And you can see here across private credit and BSL that there's a significant difference, about a full kind of one letter grade difference between BSL and private credit, but also between software and non-software deals. There's less of a delta, but still a delta amongst the protective nature of the covenants. And for those of you not familiar with our scoring system, kind of the buckets of items we cover are collateral protection, default protection, repricing optionality, value leakage, and kind of reporting protections. And we have a lot of sub data points under those categories that go into creating the documentation score. And so that's kind of like a high level overview of kind of what we're seeing in the differentiation between the markets. And then Winnie, if you don't mind going to the next slide as well. Um, and these are kind of more granular um, covenants as well in terms of excuse me, what we're seeing across negotiated terms. And so you have EBITDA definitions, assets, sales sweeps, emmets and sunsets, and inside maturity provisions. You can see there's a significant difference, not only between BSL and private credit, but also between software and non-software. And that goes also for debt capacity, restricted payment capacities, negative covenants generally, and also with respect to LME protective loopholes when it comes to CERTA, J.Crew, and Vision, and Chewy. I would note in the chart, you might see that the Chewy loophole appears to be a very significantly high number for both BSL and private credit, hovering in the 80s or 60s for non-software. But that also encapsulates what we call a qualified Chewy protection, which is typically has a blocker requirements for non-guarantor subsidiaries to be released. And so if you're including the qualified, that number goes down significantly. But I think one of the reasons, obviously, is just the broader, um, excuse me, the broader nature of private credit and BSL. I won't go into that too much, but obviously, tight lender relationships, club kind of relationships. You have kind of unity of identity as well, where you have private credit lenders being um, overlapping and cross revolving in term loan lenders. And then you have very relationship driven in private credit as well. And that's why you'll see a lot of covenants be a lot tighter in private credit. But specific to software, the reason why software covenants, that we view them as being wider than non-software, even in private credit, is a lot of it has to do with um, kind of enterprise software business being more ideal private credit borrowers in the sense that they have recurring revenue, high margins, predictable cash flows, and low capital intensity. Asset-like profile as well really helps in the sense that it's easier to lock down in a credit agreement and the covenants around IP. And and there's also just the general sense of upside bias due to the ability of software companies to scale more rapidly relative to verticals. And so I think lenders are willing to have more flexibility in the covenants that they're giving out here as well. I think
Great. So, John, kind of going into what we've seen over the past couple of years, have we observed much kind of going on in the world of software for liability management exercises, DDs or default activity? How are we thinking about that in the relatively near term?
Yeah, if you're talking about traditional LMEs, kind of what we've seen in the BSL market, up tiers, drop downs, and double dip transactions and things like that, I think the answer has been no. And I think the reason for that, it's obviously the tighter documents in private credit. I mean, when it comes to LME protections, I think private credit, generally speaking, especially in the last year or two, have really locked down documents in that sense, where you're not really seeing any, J.Crew leakage and Vision loopholes, Chewy loopholes, CERTA loopholes. Uh, I know Pluralsight came off about in late 2020, I think late last year or so, where folks were worried that might be an LME. We did that special report with Covenant Review on that. We don't necessarily view that as an LME style transaction in the traditional sense. The sponsor there was exercising kind of covenant flexibility to try to stay afloat and until they could figure out how to bridge the gap, which they ultimately ended up not doing. So all in all, I mean, we do expect restructuring activity to continue with increased frequency. We would just caution against like terminology, calling them LMEs, as we need to differentiate between coercive LMEs, right-of-way maneuvers with flexibility baked into the document and consensual negotiations. That being said, we still expect sponsors to continue to find ways to push docs in private credit. I think there was a recent maneuver in the BSL market where subsidiaries, the Xerox case, where they kind of used the definition of subsidiary against the credit agreement in that in the company. I'm sorry, against lenders in that case to to create a joint venture to get out of that. So there are still, I think borrowers and sponsors are always looking for ways to attack documents. But I think with the relationship of the private credit market being very different from broadly syndicated, very relationship driven, smaller lender groups, and other reasons, we don't expect kind of traditional coercive LMEs to be a large part of that market as in the near term as well.
Great. So, Lyle, I'd like to go back to you because we're seeing a lot of headlines lately around defaults in private credit portfolios. We know Jamie Dimon has been talking about private credit action or underwriting getting a little bit loose. And Bloomberg this morning has on top news that UBS strategists are saying that defaults in private credit could surge to as high as 15%. Now, when I look at your data, private credit defaults seem like they've already been a little bit elevated compared to the high yield and broadly syndicated loan markets. How are you thinking about defaults in private credit going forward?
Yeah. So was UBS forecast for our PMR default rate? Because if so, we're well on our way. Like as you said, we're kind of in the 9% area. So not too far. But you mentioned the difference between BSL and private credit. And we generally expect the default rate for the private credit portfolios that we rate to be higher than BSL, because we see a lot of what we've been calling, air quotes, collaborative defaults, which John kind of touched on it a little bit. These are very uncommon in the BSL market. These are sponsors and lenders working together to help the companies the issuers fight another day. So lenders agree to pick interest for a quarter, 2 quarters, whatever it is. Sponsors contribute equity, use that equity to pay down revolver, and the company lives to fight another day. So we see a lot of these collaborative defaults that we don't see in the BSL market, and we think that serves to boost the private credit default rate versus the BSL. That said, the BSL default rate ended 2025 at 4.5%, as we tracked it, while the PMR default rate ended at 9.2%. So obviously, collaborative defaults being part of the difference there.
Mhm.
As far as the outlook goes, we think that the PMR default rate will come down this year off that peak. Given the relief in rates, it did tick a little higher in January. But we think the decrease in rates will be substantial for liquidity and the ability for some of these companies to survive. Looking specifically at the software sector in the portfolio, defaults have been really few and far between. You can see on the chart there, we've only been tracking defaults on a sector basis for the last 2 years. But you could see in 2024, the default rate was considerably lower for the software sector versus the broader portfolio. And you can see in 2025, we registered 0 defaults in that sector. And it is one of the biggest sectors within the portfolio. So if you want to ask me about a forecast for the software sector, I will say it will be flat to up in 2026.
All right, flat to up off of 0%. Not too terrible overall.
Stepping out on a limb there.
Yes, definitely. All right, so let's kind of take a step back, because while software BDCs have certainly been capturing the headlines, there's a lot of other risks right now within the world of corporate credit. And I would be really curious to know, compared to software, what risk are you more focused on in corporate credit right now? Is it another sector? It could be healthcare, consumer, telecom and media, chemicals. Is it a macro slowdown or recession risk, which would be kind of a more widespread credit impact? Is that higher for longer rates where we are not getting any sort of kind of borrowing cost relief for the world of LevFin? Is it something very private credit specific? Opacity, valuation, marks, bubble activity? Are we concerned about the geopolitical and all of the moving pieces there? Or is it F? Is software is your top concern? You just really are very focused on software. And I think that this actually kind of introduces an interesting question we had from the audience is, do you have any data on overall retention, churn rates for software? Is AI, Claude impacting any companies, or is this all speculative? From my seat, I talk to a lot of clients within the world of financial services where I think that there is worries around kind of adopting new technologies and replacing humans and replacing kind of legacy. And so far, it seems like a lot of the adoption is in addition to rather than a replacement for. Lyle or Andrew, I'd be curious, like, do you have any concrete stats on retention and churn rates that are truly alarming to you?
I don't have any specific rates or specific stats, but I think a lot of it is more speculative. If you think about the Claude coding, I believe it was only recently that it was able to fix the mistakes, right? So,
Mhm.
well, that's something that is not exactly good news for any coders on this call. It just happened, so it'll take a while to see what happens to the softwares at these portfolio companies that private credit has lent to.
Great. Thanks, Andrew. Lyle, do you want to chime in with anything there before I go to the audience responses?
No, I'm looking forward to the audience responses. I
Oh,
don't have
oh,
anything, any specific metrics on churn to share.
sounds good. All right, let's check it out. All right, so the audience, the top of the worry list right now is private credit specific risks, the valuation marks, bubble activity, etc. A macro slowdown, recession risk is second on the list, then kind of a tie between software and other sectors. And then geopolitical and higher for longer come in second to last and last. And Andrew, I think that this is a good opportunity to ask you a question that a couple of people from the audience have submitted. And the gist of it is, how worried should we be about the marks for BDC and private credit portfolios? Is there a high chance that there's all these names marked at par that can't catch a bid and are going to need to be aggressively written down and see significant impairments? How do you think about that dynamic?
So one of the interesting things about the valuation question has been that Craig Packer on the Blue Owl call emphasized that these were bought at par, giving a boost of confidence, outside boost of confidence in their valuation marks. So you can easily make a case that folks are marking these books right, or at least Blue Owl is doing a good job, but it's just really interesting because when you look at the way these marks function, you're seeing different numbers come from different firms. Generally, if it's within a point or two of each other, it's in the same neighborhood, makes sense. But it becomes a lot harder to judge the accuracy of it when the company actually falls into distress, because you're seeing these various scenarios play out, on different assumptions. But if we step back to look at the broader process of it, there's generally a third-party audit that offers a valuation opinion, and then it's largely up to the fund manager which mark to adopt. It's not like they, say willy-nilly, like, oh, we'll take the highest one for this one, lowest one for that one. They have a policy that's generally disclosed in their, I believe, 10K. And one of them that has been mentioned to me is like they'll just take the middle bid. So they're trying to be judicious, but also they are ultimately in charge of the marks that they present.
That is super helpful. I know that coming into this year, when we were working on our private credit outlook, the expectations just in general were that performance headwinds were likely going to be more challenging than in the past couple of years. We have the dynamic of falling base rates and yields, tighter spreads. Andrew, what are you hearing in terms of the flow of cash into the private market? Is it stopping? Is it reversing to an outflow? Is this something that you're particularly worried about?
So it's really interesting because I think we can look at the non-traded BDCs as what's the right word? A proxy for this as to how it functions in the overall market. I talked with some BDC analysts this week about that exact topic, and the question is, we're not sure because it's again too early. The tender offers are quarterly, and so it'll take a couple quarters for that to play out. But the question that's worth looking at is, what's their net inflow, right? They fundraise continuously. So if they have, just, to make math easy, if they raise 100 million and then they have a, 50 million in outflows, like they net 50 million, right? But what happens if those numbers are reversed? A shrinking BDC is a bad BDC because all of the credits that are good will leave first, being left with the quote unquote bad paper. And note that, that was a general statement, not, specific to one firm or the other, just in principle. But when you look at the things to be worried about, or if you're worrying about it, specifically look at how those net flow numbers are going.
Absolutely. Gotta stick up to the net flow numbers. So Lyle, on your side of things, your portfolio monitors not just tech and software companies, but a whole host of other sectors. A good number of people in the audience said that there was another sector that they're more worried about. How are you thinking about that? Is software just the tip of the iceberg in terms of sectors we should be worried about? We know that default rates in the PMR have been elevated, not due to tech and software. So, what are you looking at in terms of exposures to challenged sectors in the private markets?
Yeah, so that there hasn't been a lot of concentration on a sector from a sector perspective as far as the defaults goes. Um, I'd say the one sector where we have seen, probably more than their share of defaults, that's a meaningful sector in the portfolio, is healthcare. Healthcare is a top three sector in both of the portfolios that I mentioned. In the PMR sector, it's about 8%. In the CLO, credit opinion portfolio, it's closer to 15%. And it's been active as far as defaults go. It's a popular sector for private equity firms to engage in roll-ups. So we've seen roll-ups of physician practice management businesses, um, dozens of different kinds of therapy practices, dental practices, et cetera. And when you lever up a company 6 to 7 times, you need everything to go right, right? And what we've been seeing within these different silos within healthcare is companies struggling with reimbursement issues, labor issues, and with recent regulation rollbacks of Medicaid. We think that could get worse for certain subsectors that are more exposed to those sort of things. So healthcare is definitely one of the other sectors that we have our eye on. But quite frankly, what we've been seeing over the past couple of years is just, you know, there are bad businesses in every sector, and bad business models, and those have been the first to fall. And I'd say it's been a pretty diverse set of default sectors that we've seen defaults in.
All right, so the game of whack-a-mole shall continue across credit markets from a sector default perspective. So, John, let's wrap it up on the covenant side of things, because when we're thinking about recoveries, covenants are ultimately going to be highly influential in that. What else should investors be keeping in mind when we are thinking about covenant quality and we have these sector-specific challenges going on?
Yeah, I think and just high level, I mean, I think revenue quality will always beat kind of covenant tightness every single time. And so just putting that out there as context, um, I think that will always determine whether a company can refi as well. But then when you're thinking about covenants, you're thinking about making sure you have proper reporting governance. If you have board observation rights or monthly reporting packages, making sure those are getting in. And then you're really looking at, incremental debt capacity. What can these companies incur without going out? Uh, to try to refi where markets might not be readily available. So all those things, and then I think the obvious one is making sure your LME protections are tight and locked down across Certa, Chewy, Envision, League Balls, and et cetera, to make sure that if there is an issue that, particularly in private credit, you are coming to the market and talking across the aisle. So
Great. Thank you, John. All right. With that, we have made it through 60 minutes of software, private credit, BDCs, covenants, all of the very highly topical themes for the market right now. I want to thank Andrew, John, and Lyle for joining me today. I think that this was a really helpful conversation. Thank you all for listening in. For the 28 people who submitted questions, thank you for the questions. If we didn't address them directly, we will be following up with people. And if anyone has other follow-up questions for me or the rest of the team, you can always reach out to us on the CreditSights or Fitch websites. All of our email addresses are listed here, and everyone will be getting a copy of the slides after the presentation. All right, thank you all. Good luck with the rest of the quarter, and we will be back next week with a strategy webinar for our global market update, and we'll be featuring our chemicals team, yet another sector that is a little bit choppy as of late. And with that, we will wrap up the webinar.